Hey guys, welcome back to the channel. On today's video, we're going to be discussing ZWU. Now, if you haven't heard, it's BMO's covered call utility ETF. It's pretty popular in covered call strategy circles. I think it's a very interesting one to hold. We're going to be going over the holdings, the type of yield you can expect with it going forward, and if any, capital appreciation. First, you should always know what you're buying. So let's take a look at what the sector allocation is. 53% is in utilities, 27% is in communication, and 18% is in energy. Now, they call it a utility ETF, and I think it is, but we're using the word utility a little bit loosely here, because if we're using telecommunications and pipeline specifically, not just energy, I mean, it's a little bit loose, but it is what it is, and it's an acceptable definition. Now, geographically, this is mainly a Canadian ETF, with 70% being in Canada and just under 30% being in America. Now, if we look at the top holdings here, the top holding is the BMO Equal Weight Utility Index ETF, then Enbridge, then Pembina, Bell, TC Energy, Rogers Communication, TELUS, Fortis, Duke Energy, and forgive the pronunciation, but Excelon Corp. I'm not too familiar with that one in particular. However, if you notice here, there's a ton of midstream pipelines, and that's where the big yield is coming from, but that's not all. This ETF uses a covered call strategy where the fund managers write options and they make the dividend higher than it would be if you just held all these individual companies. The distribution yield is actually 7.4%, which is extremely high. Like I said, way higher than if you had bought the underlying holdings and just held them. I believe the highest individual holding is Enbridge, is just under 7% of a yield. We're talking 7.4% for this ETF. The distribution is monthly, so it's great for people who need income on a reoccurring and consistent basis. It's everyone's favorite thing to get these payments monthly. Quarterly is okay. Semi-annually, a lot of people just avoid that type of payment frequency. Now, another thing I want to touch on is the management expense ratio, which is 0.71%, which would seem extremely high if this was not a covered call ETF. Covered call ETFs have higher management expense ratios. You have to compensate the people who are making these option trades for you, okay? This is where your income comes from. And honestly, if you compare this to a mutual fund with a 2.5% MER, this is looking still pretty cheap, guys. It's just a lot higher if you compare it to just a regular indexed ETF, okay? So keep that in mind. It is reasonable. Don't let this number stress you out. It's within an acceptable range. I just want to point out something here. Now, for all BMO's ETFs, they always have a little bit of a risk rating. This is subjective, but when they put out covered call ETFs, they always rank it medium high, or the smallest I've seen is medium risk rating. So for them to put a low to medium, I mean, I find that interesting. I guess they really believe on the safety and security of the underlying utilities in this ETF. It's just an interesting side note here for you guys. On the screen here, I just pulled up a 5-year chart of the ETF. So if we take a look, 5 years ago it was around $14. I mean, we had a big sell-off in March. This is very understandable, but we've recovered to about 13. So this ETF is not for people who are looking mainly for capital appreciation, because it really is not going to be there. You might get a minimal amount depending on when you purchase this ETF, but the main purpose of this ETF is income. It's for investors who want their money now. It's for investors who want their money monthly so they can pay for their bills and their everyday lives. I mean, you can choose to just keep reinvesting it and compounding. That's another strategy a lot of people like to do. But just keep in mind that you could hold this for 5 years and it could be worth $12, okay? So keep it in mind. Know the product that you're purchasing. Really think about if it's right for you. On a side note, guys, I'd appreciate a like or subscribe if you're enjoying the content of this video. Thanks, I appreciate it. Okay, so back to the video. Now, another thing we want to consider when deciding if a covered call ETF is for us is the NAV, okay? That stands for net asset value. You get this number by subtracting the assets from the liabilities, all right? So if we do that for this ETF, we get $13 per share. And the market price right now is $13.10. So the difference is not very much. So this is in a very acceptable range. That is not a red flag for me. This means it's okay. So overall, guys, this is a really good ETF. The distributions are so high, 7.4%. I mean, the monthly payments are great. You can really start compounding this or just pay your bills with it. In fact, I'm going to start a position in this. If you combine ZWC and ZWU, you've got the Canadian sector just 100% covered. You've got all the best stocks in there, but you're getting the benefit of the covered call income to raise your yields. It's fantastic. I hope you enjoyed the content, guys. I'll see you on the next video. Keep investing.